Right now, Sanmina Corp is trading live at $167.33. That's up $3.75, or 2.29% on the day. And you should know, it just tapped a new 52-week high of $168.12 moments ago. The volume is active, and the market is clearly reevaluating this name in real time. But here's the critical point most people are missing. This is not the same Sanmina it was even a few weeks ago. The market is treating this like a standard earnings beat. But the reality is that the company just fundamentally altered its entire DNA. The expectation, the narrative that everyone has held for years, is that Sanmina is a reliable, somewhat sleepy, diversified electronics manufacturer. A solid hold, a component of a stable, perhaps boring portfolio. The reality? Sanmina just announced an acquisition and forward guidance that effectively tears up that old story and positions it as one of the most aggressive new players in the artificial intelligence and cloud infrastructure space. What we are witnessing today isn't just a post-earnings drift. It's the market trying to frantically reprice the company that just told Wall Street it plans to potentially double its revenue. Let's establish the common ground, the old expectation. For a long time, if you were doing some self-investing and looking for industrial exposure, you might have come across Sanmina. You'd see it as a contract manufacturer. They build complex systems for other companies. Think high-end medical devices, communications network gear, industrial controls, and defense technology. It was a good business, a necessary business, but not exactly the kind of story that gets Robinhood stock trading accounts buzzing. It wasn't Tesla stock, with its massive volatility and cult of personality. It wasn't Apple stock, a consumer-facing behemoth. It was a behind-the-scenes operator, and analysts generally kept hold ratings on it, with price targets that suggested quiet, modest growth. If you had it in a Schwab Intelligent Portfolios account, it was likely there for stability, not for fireworks. The expectation was low drama, steady execution, and single-digit growth. Now, let's look at the reality that just shattered those expectations. The company just reported its fourth quarter 2025 earnings. The numbers themselves were good. An EPS beat at $1.67 versus the $1.57 expected, and revenue that also topped estimates. But that's not the part that matters. The bombshell was the guidance for the next quarter, Q1 2026. The analyst consensus was looking for earnings around $1.58 and revenue of about $2.1 billion. Instead, Sanmina guided for earnings of $1.95 to $2.25 per share. That's a massive beat. But the revenue guidance is the real story. Management guided for $2.9 billion to $3.2 billion. That is not a typo. They guided for, at the midpoint, roughly $1 billion in additional revenue in a single quarter. This isn't just growth, it's a phase shift. The reason? Their very recent acquisition of ZT Systems' data center infrastructure manufacturing business. This single move injects what management describes as a $5 to $6 billion annual revenue run rate business directly into Sanmina. Think about what this means. This isn't a company just getting better at its old job. This is a company that has bolted on an entirely new high-growth engine. The ZT Systems deal makes Sanmina a key U.S.-based manufacturing partner for cloud and AI infrastructure. We're talking about the server racks, the complex systems that house the high-performance computing chips from companies like NVIDIA stock. As the AI arms race heats up, the demand for the picks and shovels, the physical infrastructure, is exploding. Sanmina just bought one of the biggest shovels. This is why the stock is hitting 52-week highs. The old valuation models that investors might have built on their Fidelity trading platform or viewed on the SoFi Invest app are now completely obsolete. They were based on the old company. The market is now being forced to value a business that is suddenly and deeply embedded in the single hottest growth sector in the entire market. The analyst price targets are a joke at this point. Many, like the consensus on MarketBeat, are still sitting below $100, while B of A just rushed to raise its target to $180, and even that might be conservative if Sanmina executes. This recent stock movement is all about this repricing. The volume today is heavy because institutional desks at places managing Fidelity mutual funds or Fidelity wealth management accounts are realizing their models are broken. They need to increase their exposure. This isn't a gradual climb, it's a violent repricing. The stock has been on a tear, but this latest move is the confirmation. The risk, of course, is integration. Adding a business that large, that quickly, is fraught with challenges, but the market, for now, is focused purely on the upside. It's looking at the new total addressable market. It's looking at the new, much larger revenue base. It's looking at the margin expansion potential from high-end AI hardware. For investors who do their own online investing, this is a classic case study. It's a reminder that you can't just look at the last quarter. You have to look at the forward guidance and the strategic actions. This is the kind of investment opportunity that many retail investors, whether they are on the Robinhood app or using Fidelity ETFs, dream of finding right before the rest of the market catches on. It seems, in this case, the market is catching on today. Looking forward, the picture is one of massive opportunity coupled with significant execution risk. The bull case is simple and powerful. Sanmina has successfully positioned itself as a critical supplier for the build-out of AI. As every major tech company scrambles to build its own data centers and AI models, they will need the hardware systems that Sanmina now builds at scale. This provides a multi-year tailwind that could propel revenue and earnings far beyond even today's elevated expectations. The company could use its strong cash flow from its legacy industrial and medical businesses to fund this new growth, creating a powerful, diversified giant. If management can successfully integrate ZT systems, improve margins, and prove to the market that this $5 to $6 billion in new revenue is real and sticky, the stock is not expensive at $167. It's just the new baseline. This is the kind of investment help people are looking for, identifying a fundamental shift before it's fully priced in. It seems, in this case, the market is catching on. In conclusion, the story of Sanmina Corp has been completely rewritten in the last few days. The expectation was for a continuation of the steady, reliable, and unexciting industrial manufacturer. The reality, delivered by a blockbuster earnings call, is that Sanmina has made a decisive bet-the-company pivot into becoming a central player in the AI infrastructure gold rush. The stock's surge to a new 52-week high today is not a technical anomaly. It is the market's collective, panicked attempt to figure out what this company is now worth. The old analyst reports are useless. The old valuation metrics are history. This is, for all intents and purposes, a new company trading under an old ticker. The tension between the old, boring expectation and the new, explosive reality is what's driving this stock. The company has a clear path to doubling its size, but it has also taken on a new, much higher stakes challenge. I have a question for everyone watching. Comment below if you think Sanmina can successfully integrate the ZT Systems business and hit its new, ambitious revenue targets.